Mustaches, I think we're out, but your fanny pack, man, oh man, you could be cool.
Listen, if Prada is listening to this, I could do, like that's what you would go, right? You would go Prada,
I think you could be a Prada influencer. Prada fanny pack.
Yeah, with a mustache. Ladies and gentlemen, welcome to another episode of Rein It In, episode 19, where we're going to discuss, is the Bank of Canada and its recent rate increase, is Tiff Macklem prepared to crush the economy to slow it down? We're going to find out in this episode of Rein It In. Let's unpack the news, the facts, and the data.
JG, just a quick reminder to our viewers. Remember to subscribe, to like, to share, to comment. We're trying to grow this channel. We need your help. We know you're watching, so make sure that you're subscribing and liking.
All right, Patrick, we got 6 sticky notes for today's episode. The first one we're going to talk about is this recent sucker punch provided by the Bank of Canada as they increase interest rates. Now people are worried. The market is kind of uncertain, I think is the best way to describe it. And I currently benefited from this rate increase. So I'll tell that story in a little bit. I was actually, it couldn't have happened at a better time for me. Wow. But yeah, I mean, rate increase definitely felt like a sucker punch. I didn't think it was going to be helpful to me. It turned out to be very helpful to me. I'll tell that story in a bit. But talk to me about this recent sucker punch, Patrick. They raised it 25 basis points. Nobody thought that. What was your last prediction? Your last prediction was that they were going to stay put. I predicted that they were going to decrease just because I'm a contrarian. That didn't work. I was way off, but they actually increased.
Yeah, well, that was exactly what they did. They increased and people just were not expecting it. The market was not expecting it. And so when they increased, it, of course, does a couple things. It takes the sentiment, turns it negative. We were actually having some positive sentiment. Everybody's going, okay, look at the housing market continues. People are willing to pay those interest rates. And guess what happened? Macklem comes along, goes, no, we're slowing this baby down. Big increase. Now what's going to happen is you're going to start to see consumer confidence drop. You're going to start to see the housing market slow because people are going to have to adjust to this new rate. And can they afford it? It's going to crush affordability. And I'm using the word crush. Those are big words to use, and I get it. But ultimately, that's the sentiment around it. Now, what does it mean to us as investors? Well, we keep saying it. We keep saying it. We keep saying it. We beat that drum. Rental demand will continue to increase. As will rents eventually, in just the normal course of inflation, because as rates go up, those rate increases get passed on to the end user, called the renter in this case. And we'll start to see rents continue to increase. I don't think it'll be dramatic and it won't be in all regions, but they will increase and the demand will definitely increase.
You're being a little bit of a prima donna today, Patrick. I mean, it's going to crush the real estate market. Come on. It's not going to crush the real estate market. It's taken, I will say, it has taken some wind out of the sails, because definitely a lot of markets were really starting to heat up. We were starting to see multiple offers. Patrick, we were talking about that on the last episode of Rein It In. No doubt it's taken a little wind out of those sails, but to say it's going to crush it, easy there, bud. Easy.
Okay, JG, you don't listen to me. I've told you that before. If you rewind this video, you're going to hear what I said is sentiment. And that's what's going to crush. So the sentiment will crush. Doesn't mean the market's going to crush or drop dramatically, but sentiment is definitely going to slow down because people are kind of going,
oh, I don't even know what to do right now. I cannot afford the down payment. I cannot afford the payments. And will the banks continue to extend amortization?
So that's what I was saying.
We'll have the producers rewind like a Ted Lasso episode. So let's see how that goes. Here's my story of how this recently benefited me. I've been in negotiation, Patrick, for how many months now have you and I been saying that there are incredible deals out there if investors are serious and if they're thinking about real estate as a long-term play, which you should be. You should not be thinking about this year or next year. You should be thinking 5, 8, 10, 20 years out when you think real estate. There are some great deals to be had. I've been saying this. You've been saying this. We've been talking about this for friggin' months. In fact, all of this year, we've been saying this very, very aggressively. Well, I went to lunch with my realtor, last 2 weeks ago, I think it was. He says, JG, you should look at this deal. I think there's a deal here. They're asking too much for it. They're not going to get it. It's an estate sale. Let's see if you want to put in an offer. So I decided, okay, let's put in an offer. They started by asking $700,000. They weren't getting it. This is a single family home. It's a perfect flip opportunity. So they're asking $700,000. That price came down from $700,000 to $620,000. And I'll save you the details of all the negotiation, but I essentially picked it up for $515,000, almost $200,000 less than asking. But the reason that I was able to close that deal is it happened, and I put in my final offer.
Take it or leave it.
The morning the rate increase happened. And I think it spooked the seller the same way it spooked a little bit of the market. And they thought, well, if we don't take this offer for $515,000, I might not even get that if I wait an extra day and if I refuse this offer, because my last offer was a no condition firm offer. So anyways, the point is, Patrick, I picked up a great deal. This is a great property. We're going to do a great flip on it. It's going to be an incredible, opportunity for those that are taking part of it. But the point is, I don't know if I would have got it quite at that price if it wouldn't have been for that rate increase that morning.
Well, JG, I love that you shared that story, because it really speaks to what we share with the REIN community all the time. And we talk about consumer confidence. This is a perfect example of you looking at the news, the facts, the data. You have confidence in what you're seeing because you're looking at the data. Whereas in this case, the seller made an emotional decision because they don't understand what's going on. Those are the opportunities that are out there for those who actually embrace the data that we share. Is get out of the emotionality of it, quit buying into the headlines, and opportunities. You will then see opportunities like JG picked up there. So I think it's a perfect example because you're confident in it. Why are you confident? Because you're just looking at the data. You're taking the emotionality out of it. And in this case, the vendor was very emotional in the sale. And of course, the icing on the cake, if you will, or the cherry on the whatever, was them getting that rate increase or hearing that rate increase and put them over the edge.
Yeah, so definitely the rate increase, bit of a sucker punch, but has may create some opportunities for the right real estate investors at the right time. No doubt about it. But very, very timely by the Bank of Canada and surprising to the market, including myself. I remember thinking, "Oh shit, not another one." That was my gut reaction when it first happened, Patrick.
Yeah, I get it. I was the same way. It kind of shut me down. I'm going, "What the hell are they doing?" We're going to talk about that shortly.
Speaking of that, we're going to extend this conversation to the second sticky note, which is, are the 2022 market worries coming back? 2023, Patrick, I think especially as the spring market started taking off, people kind of like a duck had shaken off the 2022 fiasco where the prices really came down, rates really went up. And by the way, for everyone to remember, that really started in the month of March, April of 2022. So it was a year later where kind of the market had normalized the new rates, the market had normalized the new pricing, and so on and so forth. The question is, are we going back to the fears of 2022? Or are we going to be able to adapt to this relatively quickly? That's the question.
Well, yeah. And I mean, if we go back into 2022, we know that when those rate increases came up, because everybody thought that and I guess we all thought, the world thought that rates would stay low for an extended period and an ongoing period of time. And in our case, Tip Macklem looked into the camera and go,
rates will stay low for a very long time.
I mean, he actually said that. And so when they did increase them, sentiment shifted right away. Everybody was freaked out and worried about where things were going. But then that all got normalized and sentiment started to shift again. And we come into 2023, rate increases have come into play. People are still spending on real estate. They're actually paying more. Prices continue to go up. They normalize the rate increase. Cool. Sentiment is positive. And by the way, the economy overall seemed pretty good. Job or unemployment rate was still very, very low. I mean, things were looking pretty great. And then boom, rate increase. Now what's going to happen is the sentiment is going to shift again, which we talked about earlier.
Yeah, it's I think what's fascinating about this, Patrick, is I think we're gonna digest this one as a community, as investors. Now, homeowners, that may be different, right? Because homeowners have a completely different. Those watching this show, most of you are investors, but homeowners, they may not digest this as much because it has a different impact on them than it does to us as investors. But I think investors are really starting to see the forest through the trees, if you will. If you're a sophisticated investor, if you're educating yourself, if you're watching this show, then you know what the realities of the market are, and you have a really long-term perspective. You're thinking 5, 10, 15, 20 years out. And as a result, you understand that you're going to be making decisions today, which in the short term maybe a little bit painful, like getting into the market when the interest rates are a little higher, but you know you're going to benefit in the long term, Patrick. And I think that I know a lot of real estate investors I'm talking to, they're more active now than they've been in the last 2, 3, 4 years because the opportunities are really showing up. Sellers want to sell, deals want to get done, people want to get into property. So it's kind of fascinating, but it really depends. It really depends. And this is kind of ultimately where I think this conversation goes, which is it depends on how the investor feels about their own confidence. You often talk about consumer confidence, Patrick, and I'm on board with that. I understand the economic impact of consumer confidence, but I think investors have to take hold of their own confidence. This is about creating your own economy and not relying on the outside world to tell you what you should be doing. Because if you do that, then you're always going in the same direction as everybody else. And as a result, you're not going to see the big opportunities.
Well, I think you hit it right on. Homeowners definitely are in a different category. That's a very emotional buy. They're being hit by these rate increases, and of course, that really affects their budgets because on top of that, we see taxes escalating. And do not mistake the reality of taxflation. That carbon tax, paying more for gas, paying more for everything actually is eating into that disposable income. And of course, which would then represent what you could afford to pay at that interest rate. So that's one part of it. From an investor point of view, there is no doubt that even some of the sophisticated investors that I've talked to are kind of getting a little bit quiet for the one primary reason, which is they had variable rate mortgages and they're seeing their payments increase and their cash flow is either limited or it's even upside down a little bit. And they're just really stuck in that mode of going, I've just got to manage what I've got here until things start to settle down, maybe rate increase or maybe there's some decreases in the rates, or I can do something different and get my cash flow back to where I need it to be. For those who have some liquidity, for those who have got good cash flowing portfolios to begin with, or even break even, this is, to your point, opportunities are starting to show up a lot. I think the other thing, JG, is in the property types, lots of condos deals being had in behind the scenes, particularly in Toronto, not as much in Vancouver, of just people who got caught thinking that they're going to assign those deals and that they weren't ever going to have to get the mortgage. Well, that, of course, came off the rails. We've talked about that many times. So there's a lot of things going on in the market, but ultimately within that chaos is always the opportunities for those who go out and kind of go fishing, if you will, and looking for those kinds of deals, because there's lots of motivated vendors that are sitting in behind the scenes going, how the hell do I get out of this?
Yeah, absolutely, Patrick. So interesting. I think the market's going to shrug this one off faster than, we've gone through a lot. We'll see what the Bank of Canada keeps doing. When's the next rate increase, Patrick?
Well, guess what? Everybody's got it scheduled. They're penciled it in for July. They're saying another rate increase in July. That's going to keep that fear and people touching the brake until after that next potential rate increase in July, next announcement.
I'm sticking with my call, Patrick. I think they're going to decrease in July. And I'm just going to, by the way, stick with that call until it comes true. I'm trying to manifest the future here.
You're like the clock, you're going to be right at some point. So there you go.
Exactly. All right, Patrick, this is actually a good time for this conversation, which is for investors, they're going to have to pick their poison. And this is an interesting way to think about it. And what do we mean by pick your poison? So I'll kind of create the context and then you can give me your thoughts on it, Patrick. But it's really time for investors to say, listen, do I get into the market now when prices are a little lower, but I got to pay a little more for interest rates? So do I get in now, or do I kick the can down the road, wait 12, 18, 24, 36 months? And I can tell you my version of this, which is in that amount of time, your price is going to be higher. Your interest rate might be lower, but your price of the property that you're going to purchase is going to be higher. So do you buy now and wait for interest rates to come down and handle the short term, or do you wait and take a chance on the future? What are your thoughts on this, Patrick?
Well, I think that's a perfect, analogy of pick your poison, because here's what we know. The Bank of Canada raised rates to slow the economy. The economy is, in fact, going to slow, and will it be a soft landing or a harder landing? That's yet to be determined. Depends what they do in July. Depends what they do in the future. I don't think the Bank of Canada knows what the hell they're doing. The government certainly doesn't. Damn! But let's put it this way. When we look at what they are potentially going to do in terms of slowing the economy down, it's going to mean that when they get it down and they're going to overcorrect, because they always frickin' do, they're going to have to do what? They're going to have to react quickly and bring rates down. And keep in mind, rates don't have to come back to, 0.50 or 0.1% or 1%. Rates just have to come down a quarter or a half. And guess what? Everybody's going back in because they're going to chase that market. They're going to chase that interest rate because interest rates are coming down. If you're an investor, you're then going to be behind the wave. You're going to be chasing the wave, trying to get out in front of it because, again, supply will be an issue. Demand continues to be, although that's an argument. I get it. We'll talk about that shortly. But ultimately, pick your poison. You come in when the rates are a little bit high, prices are a little bit soft, and they're going to probably soften a little bit or at least flatten. There's going to be deals to be had. To your point, put up with and make sure you're looking for good, at least break-even cash flow deals and buy them now, wait for the rates to come down as opposed to chasing it. I think investors are going to have to make a decision. So are homeowners, by the way.
Well, I tell you what, Patrick, I think my version of this is I think that if you're an investor and if you're thinking about your future, your financial future, you're absolutely crazy to wait and say, let's maybe do this in the future in the hopes that interest rates might come down. And I'll tell you why I think that's crazy. And it's for two particular reasons. Number one, you don't know what's going to happen in the future. You don't know if interest rates are going to come down. Yeah, you think so, Patrick, and a lot of people think so. And there's a lot of people that believe it's going to come down, but nobody knows. Nobody thought they would also go up this fast. Nobody thought they would be raised this much. There's all these various things. So to look into the future and to leave your financial future at the whim of someone else that you're hoping might lower interest rates is number one, crazy in my books. But number two, and more importantly, is you just have to change your tactic to suit the times. The reason people say they don't want to invest in real estate right now and they're waiting for interest rates to come down is because they think that whatever property type they have in mind, that's going to cash flow. Like, oh, if interest rates come down by 2%, my condo, the condo I want to buy, will actually cash flow. That's ridiculous, by the way. Just go find a better property that will cash flow. Do a conversion, get a duplex, get a triplex, buy a fourplex, buy something that will cash flow in today's market rates. And when interest rates do come down, two things happen. One, your property value will go up. And number two, your cash flow will go up and you'll be in a much better place.
Well, and I think it's something we have to shine a light on. We're not suggesting for a minute that everybody go buy. We're actually really want to shine a light on, number one, there is opportunities because there's motivated vendors out there, and go look for those deals. Don't sit around waiting for deals to fall in your lap. You can actually go looking for deals, and it's not a case of just buy anything that shows up right now. The point is keep moving forward one step at a time. Look for those deals. Don't ignore what's happening in the market, and stay connected.
Totally agree. My aim is pretty good today. All right, Patrick, the next topic, and let's talk about how Canada's housing could actually become the economic drag, which is kind of fascinating and interesting because that's the very part of the economy that's been the boom and that's been helping Canada's economy so much in the last little bit. Is it going to become the economic drag? Let's talk about it.
Well, this is a conversation we've had countless times within the REIN community and to investors overall. We've continued to point out and shine a light on just how much housing is part of our economy. It is growing and driving GDP as high as 12 and 15% at its peak. So that was creating jobs and, of course, the velocity of money. And it was doing all the things that it's doing. Now that those rate increases are there, housing is, in fact, slowing down. And some of that slowdown, by the way, is not just rate increases. It's, in fact, there's not enough supply and all of the other things that are happening. So as that slows down, because we are a debt-driven consumer economy, as is most North American, most Western countries. The point is in Canada, we are debt-driven, consumer-driven, and housing was a big part of our GDP. As it slows down, there in fact lies the risk of the economic drag because jobs in terms of builders and construction, those construction jobs will start to slow down as an example. And those are good paying jobs. That's really when we talk about the monetary velocity, the velocity of money into an economy. When you've got construction jobs slowing down, it affects everything. So it is a ripple effect that we can start to see that economy drag down because of the because of housing slowdown.
We got a cool chart to show here that really shows how the annual change in real residential investment. So, how much money is going into that residential real estate market. And it's pretty fascinating. You could see, over the years, Patrick, from 1990 to 2020 and 2023, in fact, you've really seen kind of this up and down and up and down and up and down. And right now we're definitely on a down cycle where we are down. We've declined now. We're approaching almost 20% decline relative to Q1 2022, which is essentially year to year on a quarter, like first quarter of 2023 versus first quarter of 2022. And don't forget, first quarter of 2022 is when really we saw that final push into the boom market. And then you and I, at that particular time, I remember it, I'll always remember it, early March, Patrick, 2022, you and I said, the boom is over. We're heading into slump. Get ready, ladies and gentlemen. Those who listened were very much ahead. I sold one of my properties at that point, which was right at the tip top of the market because I wanted to get out of it. Others, Patrick, were just getting into property at that part of the market, which turned out to be not a great thing. And those people are going to have to hang on that much longer. The point is this cool chart to show how this constantly is going up and down. And also we are now, we're definitely off our highs where real estate makes up a part of GDP. And I'll show another chart on this. We've been coming down, and now residential investment as a share of GDP is now down below 8%. It was above 10% for a while, the highest it had ever been. And let's compare that to the US, Patrick.
Well, I don't like to compare Canada to all these countries. You know, we and the banks, and it seems to be a thing, you know, and I've said this before, is that we keep comparing ourselves to G7 countries. And one of our favorite places to compare ourselves to is the US with 10 times the population, totally geographically structured differently. I don't know why we continue to compare ourselves to anything else. Canada's Canada, and we just have to look at the world. But having said that, when we look at these numbers, and the thing that we want to point out here, JG, is that these are leading indicators, really, because the lag is going to happen. So in other words, we see this indicator showing that housing is coming off. It doesn't show up economically like tomorrow. Oh, we got this chart today, so we should expect it tomorrow. No, it's going to come and roll out over several weeks and months that we're going to start to notice it. And that's the thing that we have to pay attention to. These are leading indicators, so then act accordingly.
Yeah. The other thing is you could see how, you know, not only is the residential investment as a share of GDP, that comparison of Canada to the US, you can see Canada's come down, the US has come down as well. But I'll put up a couple other charts where the ownership transfer cost as a percentage of nominal GDP, that has come down. New construction as a percentage of nominal GDP, that has come down as well. And this is all kind of in the first quarter of 2023. You can see the renovation expenditures as a percentage of GDP also has come down, Patrick. So all of this stuff coming down. And as you mentioned, leading indicator, this tells you where this sector is going.
You won't even see the effects of this. Probably earliest you'll start to see it is the third quarter. You'll start to see it more into the fourth quarter and then to early 2022. And we don't know what that's going to look like because in between that, there's at least two or for sure two other rate announcements, which will have an effect. And we have to keep in mind something here, JG, is that we say it all the time, is that rate increases are an influencer, an economic influencer. They're actually, they're not an economic fundamental. So continue to look at the job growth or lack thereof. Look at GDP. What is it going to? What's the impact on GDP going to be overall? Now we're saying that housing is going to have an effect on GDP, but it doesn't mean that we're going to all of a sudden go into these recessionary numbers. Although the housing market could slow down and we could start to see an uptick in unemployment, and I want to talk about that shortly too. But the point is, we have to look into the future and say, what will this mean to us in the future? But I don't think it means, because I don't think supply is really going to change. And that is that given supply, I don't think the housing market's going to crash or a bubble's going to pop, whatever language people are using these days.
Well, we're going to talk about that, Patrick, in terms of supply, because there's been some new research come out that says supply is not a problem. We're going to dig into that in just a second. All right, Patrick, for our fifth, and we got one more sticky note after this, but for our fifth sticky note, we're talking about, is the economy showing early signs of cracking? Now, I want to talk about and show a couple of charts that just illustrates, and if you look at this chart here, you can see how compared to all the other rate increase cycles, and by the way, Patrick, these are cycles. You and I talk about this all the time. We're currently in a tightening cycle where they're tightening credit in a big, big way. And you can see in this really cool chart where the cumulative change in the overnight rate, how in 2022-23, which is the cycle we're currently in, number one, it's gone higher than it's ever gone before. We've raised more than we've ever raised before, from 0.5%, 0.5, all the way up to 4.5% now. and it's gone on longer as well. So not only more than ever before, Patrick, longer than not ever before, because you can see in 97, 98, it was a little longer, and 04, 06, it didn't increase nearly as much, but it happened over the course of 21 months. So very cool chart to kind of show the difference between the current tightening cycle compared to other tightening cycles.
Well, that's the thing around it. And then what's different about all of this, I think, that makes it different than all those previous years is the rate of inflation. And a lot of that inflation is being driven by, the cost of carrying a mortgage, for example. So in CPI, the interest carrying cost is part of what's driven that inflation. We see the increase in food and fuel and all the rest of it. It keeps biting at the amount of disposable income that the general consumer has. So these are the effects on the economy that we're starting to feel. And I can't stress enough, the taxflation that I keep talking about, and it may sound like a shot at our government, and it is, but it is the reality, is that, I think our gas, the most recent stat I got is our gas charges, the tax on just our gas is like 80 cents a liter. So when you start to look at the numbers, you realize that people are out of pocket. So in other words, disposable income continues to decrease.
So then let's blend that conversation, Patrick, into the unemployment rate, because listen, the fact is we're talking about early warning signs of the economy cracking, but the unemployment rate is still an all-time low. Too low, as you've indicated many, many times. And if the unemployment came up a little bit, which is, by the way, what the Bank of Canada wants and what most business owners want, is for the unemployment rate to come up. So even though the media is going to promote the unemployment rate coming up, which it might tick up, whatever, 0.5 point, 0.5%, 1%, I don't know what it's going to tick up. But if it does tick up, it will only be a welcomed reprieve, or is that going to be marketed as the economy cracking?
Well, I think it's been, it was just a very slight uptick, and it was very specific to a general cohort of 15 to 24-year-olds. But that plays into the fact that what's happening is that the service industry, for example, some restaurants, the food services, if you will, and even the accommodations, by the way, are slowing down a little bit. And that is a real popular place for that age group to work. So those things are slowing down. I think what we have to keep a closer eye on is that as construction slows down, as builders start to touch the brake, if you will, and we've talked about this many times and we're starting to see it show up, is that I think we're going to start to see a softening in the more important part of the industry, if you will, which is the construction. And I think we have to watch very, very closely on that. Now, I think it would be great news to see it uptick to 6.5%, even 7%. Historically, that's 6.5%, 7%. We've lived in that kind of unemployment rate for years, many years. We've normalized 5%, but ultimately, if we see that 6 to 7%, we're in good shape. I think that's where we'll see the economy is actually more robust, healthier for sure. Wage increases will be really well managed in that regard, and I would actually like to see it in that range, to be quite honest with you. And that's kind of what I got on that.
I think, given the baby boomers and the trends we have with our population, I'm not sure we're going to see those kinds of unemployment rates, but time will tell.
Time is going to tell. And I think you make a good point. We may not see it, but again, it's industry specific. That's so right. As much as we may not see 6.5%, 7%, I think within an industry, we're going to see that pullback. And keep in mind, we still need trades. And what we've got for immigration is not trade quality individuals. There's lots of tech quality individuals that are coming in, and administrative, those kinds of things. But ultimately, we're not seeing trades come in. They keep threatening to get more specific. They haven't done that yet. I don't think they have that kind of control, to be honest with you. I don't think they're that well organized. Time will tell.
They're definitely not that well organized. All right, for our final topic today, Patrick, we are going to discuss whether or not, and we're going to bring this into and kind of round robin this whole thing, but StatsCan has come up and talked about how this is not a supply issue. They've issued some new research. BMO has backed up some of that research. It's interesting. These guys are saying it is not a supply issue that is impacting the real estate market. Let's talk about that. And then we'll also bring that into the conversation around the early warning signs, or the canary in the coal mine of our economy, because I know that's an important topic. First, let's talk about supply, Patrick. Let's touch on this StatsCan research that just came out.
Well, listen, I think it's one of those headlines that's much ado about nothing. It's a headline, and StatsCan comes out and says it's not a supply issue. Then, of course, Scotia, BMO, whoever comes along says, yeah, no, it's not a supply issue. There's lots of supply. When you look at the supply per capita, we have lots of supply. What they failed to mention in this particular article, and maybe it's in behind some kind of data, they didn't share it in this particular article, but ultimately, what is the supply? Is it 500 square foot units in Toronto or Vancouver? Because there's lots of that supply. And I mean, that's going to really up the numbers. And what is the demand for that particular level of supply? Certainly in the rental demand, you're going to start to see it. But when it comes to housing per se, how many people can actually live in a 500 square foot property or even 700? Maybe a young person, younger, and or a single person, I'll put it that way, and or a young couple perhaps. But ultimately, young couples that fall in love and maybe eventually want to get married, they want to have children, and 700 square feet or 400 square feet isn't going to work. So it is really, what is the breakdown of supply? Single family, condos, townhouses. We have to break that supply down. So I don't agree with this StatsCan. I think it's a little bit of propaganda, to be honest with you.
Well, the other thing too, Patrick, is this is 2019 to 2021. So that's a pretty tight time frame. It's definitely, in my opinion, listen, they want to get on the news. And that's why, by the way, all the banks jump on this stuff. They're just news. I call it news hacking.
Totally.
They're just news jacking. They're just trying to follow into the news stream. That's how the news works. It's a bunch of BS. But the point is that I would like to see them do that research for the last 10 years, 2013 to 2023, the last 20 years, 2003 to 2023, not just this 2-year period of 2019 to 2021. Why did they pick that period? I have a lot of news. I have a lot of questions around this research, Patrick, because it always seems to be presented the way they want to present it, not necessarily the facts, not necessarily the figures. But
it sells. Well, it's clickbait. Let's just put it that way.
Yeah, that's a good way to put it. Now, the question I have, Patrick, is we've come across a chart here that we're going to put in the and you asked this question, which is very good in our morning debrief. You said, JG, is this the data that shows the economic canary in the coal mine? Can you break down this chart, Patrick, because it is a very important discussion around residential investment versus the investment in machinery, equipment, research, development as a percentage of GDP?
Well, we've talked about this many, many times. And one of the things that has always stood out for me with what's going on in Canada, and I've said it many times, is that, it's a consumer-driven economy, a debt-driven economy, and housing over the years has grown to be such an important part. And as this chart shows, 2010-ish, you start to see the departure where all of a sudden we're into this housing market and people are buying. And of course, the money that's being generated within the housing market, the jobs that are being generated, the velocity of capital that's going into it is a bit of a distraction. It's like, our economy is really awesome and everybody's working in the housing industry and everybody's buying a home and renting property and investors are jumping on board and all of our focus is there. And what people were not paying attention to, they didn't need to. I mean, at the end of the day, we're working, we've got money, we've got a home, things are cool, investors are making money. What everybody was ignoring, I think, and something that I continue to shine a light on, especially over the past 3 or 4 years, is the fact that research and development, Canada isn't doing it. We're relying on the US for our R&D, and it's just not happening. And then we look at manufacturing, we look at our import exports. So ultimately, that's been on the decline for several years. And our import exports, you just have to look at the number. It seems like we're satisfied with 1 or 2% spread. It's either positive on the import and negative on the export or vice versa. It's just really a flat line. I've said 100, I can't lost count of how many times I've said how frustrating it is to ignore the fact that Canada has what the world is looking for, especially right now on our commodity front, and not just oil, by the way. You can go right across the board. We have got commodities galore, yet we are now on this ESG bandwagon that we have to pay attention to climate and climate change and environmental. And oh my gosh, why would we ever think about shipping oil or expanding our ability to do so, and or any of the other commodities that we have? And we don't have a business case to ship and to send natural gas to Germany. Like, this is absolutely a self-destruct to me. And it's like our government is literally pushing the self-destruct button. I don't get it. And now we're starting to see the spread. My concern is this. you can't have both housing and manufacturing research and development, because research and development really does add to GDP. And you've got both of them declining, and that's just not good news. And we have to pay attention to that, because I think when we talk about a soft landing, everybody's focused on the real estate market, and everybody seems to be ignoring what's happening below the surface, which is what's happening with R&D and exports. And, you know, that's a concern. Manufacturing, it's slowing down. It's been very soft.
You heard it here first, folks. Patrick Francey making a play to be the Prime Minister of Canada right here. I think that was your platform announcement, wasn't it, Patrick?
I want to be the guy that fires Trudeau and Tiff Macklem. I just want to be that guy. I know that's political, but I just want to go, you're fired. JG, remember, 24th, 25th, we've got the Real Estate Accelerator Summit. We've got new technology coming out. This is the time to get engaged and be engaged with where the future is going. The Real Estate Investment Network is going to lead the way like we always do. And you need to get registered. You listening, not only do you need to subscribe, like, and share, you need to get registered for the Real Estate Investment Network Accelerator Summit.
Ladies and gentlemen, we hope that you've enjoyed this episode. Please stay tuned and watch the next episode. We're going to be back very, very shortly. And join us at the upcoming Real Estate Investment Network Accelerator Summit, June 23rd and 24th. 23rd in the evening, 24th throughout the morning and into the afternoon. You won't regret it. You're going to love it. Check it out.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click there.